Joining me on the sidelines of the CLSA annual investor conference being held in Hong Kong is Aashish Agarwal, Head of Research at CLSA India, and of course a specialist as far as the banking financial space is concerned. Ashish, thanks very much for your time.
Thanks a lot.
Great to have you with us here. If there's one space where there is maximum expectation and everything kind of links up, it's the banking and financial space, right? Markets have had a huge leg up. Financials and banking have sort of, in a way, led that. But how are you feeling about the space now?
No, I think the space has given phenomenal returns over the last couple of years and still remains fairly attractive in terms of valuation, in terms of outlook. We have always believed that the banks is the best way to play the India growth story because practically it's the only space which has good exposure to capex cycle, working capital cycle, retail demand, no matter which part of the economy you want to play. I think banks, and particularly Indian banks, are definitely more leveraged than some of the regional banks as well.
Let me get you a sense of ownership levels as far as the sector goes. I mean, are they fair now? Are they relative to what period you want to look at?
I think ownership, foreign ownership has definitely gone up in the last few years. In terms of what we call technical overweight, underweight, it has been a sector which has been overweight for foreign holders for quite some time. And I think that would continue to be the case. But still, there is a lot more money, incremental, that can come in, both dedicated money as well as ETF money. Banks remain one of the largest weight in the MSCI, in the Sensex. And hence, any fresh flows into India, a large part of it would find its way into the banking stocks as well.
Over the last 3.5 months, how has that changed? I mean, ownership levels?
I think over the last 3.5 months, there has not been a material shift. In fact, to some extent, other sectors have seen fresh flows, particularly mid-caps, capital goods sectors. Banks have not really seen that much of an inflow, which also, again, makes it very well positioned from a 3 to 6 months perspective as well.
Okay. The basic view is, how well or badly the economy is doing. Or right. What is the pace of the pickup? What is your view, Aashish?
See, I think growth will take its own time to come back. We're not very bullish on the credit growth numbers per se. I think we'll still go through one round of deleveraging that will continue over the next 6 to 12 months, which itself will be a good valuation catch-up for some of the private banks, corporate lenders, public sector banks. And following that, we should look at growth going up to 16–18%, but that's more like an FY16 phenomena. I think FY15, particularly the next 2–3 months, the headline credit growth numbers can remain fairly subdued. We can even see credit growth falling to single digit, largely due to the base effect of September 2013.
And pick up in second half of fiscal 16?
Yes, more or less second half of FY16, because even if you see fresh capex being planned by corporates now, fresh infrastructure projects being announced, I think it will take at least a year or so for them to fructify into disbursements, and hence we are saying more second half FY16.
But don't you think we are still sort of resolving a lot of the earlier announced capex, and that is still to sort of we still have to get by that before fresh projects are announced?
Yeah, so that's why I think what I meant is that deleveraging is something that would go through over the next 6 to 12 months. Deleveraging would be through asset sales that some large corporates are already planning to do.
You think the pace has been slower than what has been expected?
Actually not. I would say the pace has been fairly impressive. I think almost $8 billion plus projects or company stakes have been sold over the last 12 to 18 months, which is not small considering that historically...
So this includes assets, QIPs, all kinds of...
No, I'm talking about pure asset sales.
Pure asset sales. $8 billion.
Sales, yeah, $8 billion.
I guess it all adds up.
It all adds up. Asset sales, including stake sales. Some of the large companies, promoters have exited completely. All that add together, foreign investors, strategic investors coming into, all that adds up to $8 billion. Plus, over and above that, what we are now seeing is the second stage of deleveraging, where a lot of projects are getting operational. And hence, we are seeing a significant jump in cash flows, EBITDA levels. There are companies that are likely to report 4x to 6x jump in their EBITDAs over the next 6 to 12 months, which itself is a form of deleveraging. I think the third leg of deleveraging would be capital raising. We have seen part of it, but I think a lot of it is yet to happen. So over the next 12 to 24 months, I would expect a lot of so-called leverage corporates to come back into equity markets, raise money, helping them to overall deleverage their balance sheet.
Ashish, is there we talk about the supply side quite a bit, but is there a demand problem in many sectors of the economy, at least in the near term?
I think demand is largely sentiment. So what we have seen so far changing in sentiment. So whether it is footfalls in auto car dealerships, whether it is footfall for home buyers. So that it's a virtuous cycle. So once it starts, the sentiment improves. It creates demand, in which in turns creates fresh capacity, which in turns create demand for ancillary sectors, whether it is cement or anything else. So I think it's a virtuous cycle. It's still very early. We need that cycle to continue, but that's, as of now, it's a hope also for us.
The NPL issue and how banks are dealing with it. What's your view? I mean, the regulator, the government, and banks consequently, all have gotten a lot more aggressive.
True.
Is that, I mean, do you see it, the result being a more fast-paced resolution?
I think it's encouraging to see what has happened in the last 12 months on the resolution of NPL side. Banks are clearly acting much more together. They are doing joint meetings with some borrowers. They are trying to sell down distressed assets to asset reconstruction companies who specialize in recovery. There is a lot more talk about being very strict with the defaulters, etc. So it's nice to see what's happening, and all this is happening also at the same time when economy seems to be picking up. So I would expect recoveries to be much better in the next 12 to 24 months, maybe even in line or better than the previous cycles that we have seen.
Some that I've spoken to have said that we'll actually see one more leg when NPLs, incremental fresh stressed assets, actually go up.
Yes.
Do you believe that will happen?
So I think NPLs will keep rising because there is still a huge stock of restructured books that the banks are sitting on. The pace of NPL accretion has definitely come off. So, will they rise in absolute levels? Of course, yes. We are growing 15-16% even now. So the NPLs will keep rising. But as a percentage, the total stressed asset ratio seems to have peaked out.
Seems to have peaked out. And what do you think the incremental addition would be at? I mean, at what pace by, say, the end of the year?
So I think you could see another 20-25% increase in NPLs.
Absolute terms?
In absolute terms.
Okay.
March to March, of course. I'm ignoring what happened in June for this moment.
Okay, so that will be the end of, by the end of the financial year?
Yes, that's right.
Okay, another 25-odd%.
Yes.
And in proportion, obviously, to, whatever restructured books.
Yes, in proportion. So roughly the thumb rule is that 15 to 20% of restructured book historically has slipped into the NPL category.
Okay. So when we talk about NPLs, I think people have very firm views about what will happen in the near term. Timelines can vary a little bit, but the government also is fairly active in the space. It's talking about fewer consolidation in the PSU banking space. RBI is talking about freeing up PSU bank balance sheets, reserve requirements being lessened, etc. Private licenses being issued. What is the shape of the banking scene in India going to look like, according to you, 3 years from now?
Well, interesting. I think 3 years from now, clearly a lot can change. I would definitely expect fewer banks. So consolidation predominantly in the public sector bank space. Maybe the large banks would acquire some of the smaller banks which have capital deficiencies, because clearly large banks are much better positioned to raise equity compared to some of the smaller banks. I think private banks will continue to become bigger and more relevant. Maybe the pace of market share shift from the public to the private will actually accelerate. I think you will see a lot of new banks coming in, payment processing banks. Maybe there are niche banks that could shape up. So I think a lot would change in the sector over the next 3 to 5 years. I would also expect some disintermediation happening for the sector, with the corporate bond market becoming a little more active and hence taking away some market share and the lending opportunity from the banking space. So yes, a lot more action likely. On the regulatory side, I think it's interesting to see RBI becoming a lot more pragmatic, easing out rules, allowing banks to reduce rates, maintaining profitability, and hence you would expect a lot more, affordable interest rate, in turn helping new projects or new capex from the corporate side as well.
But you're saying profitability should come off for private banks, or?
I think what they will do is whatever regulatory benefits they have got, they will pass it on by lowering the interest rate and in turn maintain the existing level of profitability.
And when you said that lesser number of banks, you're referring to PSU banks?
I'm referring to the PSU banks.
PSU banks. I mean, what, 5, 6, 7?
I don't think it will go down to that level. Even if we reduce 6, 7, that's good enough to start with.
Right. Okay. Fair enough. Some 30 odd PSU banks right now.
Right. So 25 odd, yeah.
The other sort of thing which the government has been talking about is cleaning up the PSU bank space. I mean, bank chairmen being questioned and transactions, etc., coming under scrutiny. some believe it's actually a very focused PSU bank cleanup kind of approach. Do you believe that is what is happening?
See, there is definitely a lot more acknowledgement or recognition that PSU banks need to be a lot more profitable than what they are. So, for the first time, we are hearing the same sentiment from the PSU banks, from Ministry of Finance, from the regulator, that yes, there is, this group of banks which control 75% market share. They are not as profitable as the private, but there is a lot more that can be done to make them profitable. I think it's a good acknowledgement, and going forward, we should see some changes in profitability of the public sector banks. Part of it will, of course, happen because of the NPL cycle, nearing an end, and that itself will mean lower credit costs, better profitability. But certain structural changes, management, getting independent directors, making them more accountable, would go a long way as well. And as I said, consolidation would be an integral part to turn around the public sector bank as a group in terms of profitability.
But do you think if the government goes all out in terms of scrutinizing transactions and things, it becomes a sort of a witch hunt? I don't want to use, it's not exactly a witch hunt, but if it assumes that those kind of proportions in terms of scale, then is there a risk that the industry kind of sort of clams up the PSU banking space?
Well,
people are afraid to lend for the fear of being scrutinized later.
Well, yes, there is always a risk. So, an idea is only as good as it is executed. So clearly, the idea to turn around public sector bank is a great one. It's not that the first time we have heard about it. The execution is a challenge, and how the government goes about it, or how the ministry goes about it, or either regulator goes about it, will of course determine a lot as to how the public sector banks react to it. Of course, if there is a witch hunt, as you say, there is a chance that you might get into public banks getting into their own cocoon and slowing down lending, which in turn can hurt the economy bigger. So how it is executed is, of course, even more critical than whether they.
But do you think some of that is already happening? Some of that is already underway? Do you sense that from your interactions?
I haven't really picked up that, there is micromanagement from any of the government bodies or regulator. But yeah, I think PSU banks are not really willing to lend as much as they were historically, because the sentiments are not that great. Things have changed in the last few months. But 6 months back, I don't think bankers were per se comfortable taking new exposures given the uncertainty on the economy.
The other issue is the, say for example, the PM Jan Dhan Yojana, right? Financial inclusion plan, bank accounts for all, insurance and overdraft. Does that sort of, put a big cost to PSU banks, which may well be unrecoverable?
See, again, it's a nice idea. It would depend on how well it is executed. If you have your checks and balances before you sanction the 5,000 overdraft, then it's a great idea. You get a lot more people into the banking circles, getting them early. That is good over a longer term, because these were people who were not into the banking population, and the multiplier effect as they start banking with legal
But there is
channels.
a school of thought which says that people who want an account can get an account.
I don't think that was the case. Documentation was a big risk. Effectively, the program does simplify the KYC norms to a certain extent. So there is a risk if banks go overboard, or if any channel goes overboard, there is a risk. Is the 5,000 rupee overdraft a potential to be a moral hazard? I would say yes. So execution again would be very, very critical.
As an analyst, say for example, I'm just chasing that 5,000 rupees. How much of it do you think is at risk?
Well, too early to comprehend a number, but it's not. I think it's not the absolute amount; it's the moral hazard. People opening multiple accounts, trying to willfully default. It's an evil that can spread in the system. So absolute amount, even if you're talking about a couple of million accounts, it's not that big compared to the NPLs that we have seen in the Indian banking sector. But as I said, it's the moral hazard. It's not a precedence that you would like to set.
Okay, fair enough. In the PSU banking space, what are your top picks?
So we like SBI, which is the largest, and we believe it's the best PSU bank to own in the longer term, largely because they are one of the few ones that have protected the deposit franchise in the last decade, when practically most public sector banks have seen an erosion in deposit franchise. Secondly, they are also best positioned to raise equity as and when they need it, given, again, their dominance in terms of absolute size, market cap, etc. So I think it's the best positioned public sector banks to play in recovery as well as to be defensive.
Right there, top of the list.
I would say.
And you have others as well. I mean.
Yeah, so I would say, I would stick to the large ones. Okay. All the tier 1 public sector banks, whether it is a Punjab National Bank or a Bank of Baroda. These are banks that would be a good choice if you want to stay invested in the public banks. We, of course, as a house, have preferred private banks for quite some time now.
One specific issue about large corporate sort of NPLs. Are you seeing any signs that might become true? Because, I mean, the stress was in SMEs, agriculture, etc. Large corporate, large scale, we haven't seen. Now you have Bhushan Steel, you have a couple of others which we hear about. Are these one-offs, according to you?
So, the names that you mentioned have not yet turned into an NPA. I don't think there is a real risk of large corporate turning into an NPL. Okay. Names that have been well talked about. Right. Simply because most of these corporates have very good quality assets on the ground. Okay. And that's why, I was mentioning earlier that deleveraging is a theme that we have believed in over the last year and a half. And it's good to see that playing out. So, corporates are selling assets to protect their overall group from becoming, non-performing asset. So I don't see any risk of large corporate defaults in the next 6 to 12 months.
What about the private sector? I mean, what are your top ideas there?
So we prefer the corporate lenders because they are still trading at a discount to the retail lenders, largely because of the concern on corporate asset quality, the large corporate. And as these concerns recede, and we have seen that in the last 12 months, we still think there is a lot more to re-rate on the corporate side. So, ICICI Bank has been our top pick in the sector. Followed by Axis. So those are the top 2 private banks we like. In the mid-cap space, we have liked IndusInd Bank, which clearly is a bank that is well positioned to become a large bank over the next 3 to 5 years in our view.
With these private sector banks, there's also been the issue of, the age limit as advised by the RBI. Now RBI has, of course, said, well, the age limit can be 70 years. Does that remove a large, was that a big issue, for investors?
Well, continuity is always appreciated. So, if you have had a bank chairman who's been there with the bank for 20 years, and you suddenly are made to believe that there is a risk that he may not continue, then of course, uncertainty is something that markets don't like in general.
Sure.
So to that extent, continuity, certainty is going to be rewarded. It could reflect in valuations of these banks which had the overhang of the chairman due for retirement or the MD is due for retirement in the next 12 months.
So IndusInd and HDFC Bank
in particular? They would be benefiting from this guidelines.
So, you're saying it's a meaningful thing for investors?
From a market perspective, from a sentiment, of course, as an entity, they both have delivered under the current leadership. So it means a lot for the entity. But for market, as I said, uncertainty has always been given a discount. Certainty would be given a premium. So it's a meaningful thing.
Aashish, thanks very much for your time. Good luck with the conference. Thanks very much.
Thank you.